Liquidity is changing. Obviously, the interest rates are responding. But this idea of is capital going in or is capital coming out is really important for asset prices. Global liquidity has actually been going down. And so naturally, the S&P turned over, Bitcoin turned over, right? We got these drawdowns. And so the question becomes, how much is it going to draw down? I think that people are misunderstanding the strategy that is at play right now. I think a lot of people think Donald Trump on January 20th is going to walk in there and be like, tariff, 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 tariff. Instead, what I think he's doing already is threat of tariff, threat of tariff, threat of tariff.
What if I told you Bitcoin's biggest price swings aren't just driven by hype, but by a hidden force that controls the entire financial system? Anthony Pompliano dives deep into the unseen power of global liquidity and how it's shaping Bitcoin's future. Are rate cuts a blessing or a curse for your portfolio? Stay tuned, as the answers will surprise you.
Well, liquidity drives markets. And so if governments around the world are pushing more liquidity into the market, think of it like water, right? That's why it's called liquidity. When they push it into the market, everything goes up. And so you see asset prices rise. If you got a bathtub full of water and you start to drain the water out, what happens to all the little toys that are floating in your little kid's bathtub? It starts to drop, right? And so liquidity can be this like buoyant force, or it can be this draining force in the market. And the word liquidity is such a great word because it's literally showing you either it's pushing asset prices or it's pulling them down. And so if global liquidity, if M2 supply is coming down, asset prices likely will follow. It's not immediate, right? It takes some time to work through the system, but it can be, within a couple of weeks, you can start to see those asset prices come down. The good news is that global liquidity, goes up, goes down, but over the long run, the trend is up and to the right. And so therefore asset prices should be up and to the right as well. Well, I definitely think that rate cuts matter, right? And use the extremes. If rates are going up, then that has a draining function, right? It makes capital more expensive. If capital is more expensive, it's harder to move around. If you are cutting interest rates, it makes capital less expensive. If it's less expensive, it's sloshing around. It's much more freely, right? So think of interest rates almost as like friction. You're increasing the friction to capital, you're decreasing the friction to capital. And so anytime that you are decreasing the friction to capital, well, that means more people are going to have access to capital. If more people have access to capital, it means they're deploying more capital. And so therefore asset prices should go up. You're increasing the liquidity in the market. If you are raising rates, you're doing the exact opposite, right? It's a draining function. It tightens, it adds friction to the system. And so just on kind of a binary, are we cutting or are we raising? Obviously that has a massive impact. I tend to think that interest rates and liquidity are somewhat interlinked and they kind of work in tandem to a degree. But global liquidity definitely is the thing that I would spend more time paying attention to than the interest rates, although there is some, kind of back and forth. As liquidity is changing, obviously the interest rates are responding. But this idea of is capital going in or is capital coming out is really important for asset prices. Well, I don't care what Wall Street says, right? How many of them were right in 2024? Why are this like guessing game doesn't really matter. Now, what people can do is they can say, hey, look, we're trying to figure out what our expectation is. We're trying to plan around that. Is capital going to be more cheap, less cheap, etc. But ultimately, the kind of analyst expectation game, it's nearly impossible, right? What are the odds you're going to get the exact number correctly, right? And actually, if an analyst was intellectually honest, what they should do is they should not only say how many cuts, they should tell you in advance which meetings do they think the cuts will happen at, right? Because sequence matters as well. And so now not only do you have to get the exact number correct, but you got to nail every single meeting. How can you pick what's going to happen in the Fed meeting 12 months from now with no inputs, no data points, right? It's very hard. And so I tend not to pay attention that much to kind of the analyst expectations. And it's much more valuable to just listen to what the Fed said, right? And so I do think that there's been some language where, hey, they've made some cuts that they seem to be kind of cooling off on, that cut process. But I do think there will still be cuts, right? And so your question about how much does that impact financial assets? Well, it also depends on which asset class are we talking about, right? Obviously, something like real estate, the name of the game is interest rates, right? Even more so than global liquidity. And then if you go to maybe stocks, well, large cap stocks are much less reliant on interest rates versus small caps. Small caps tend to borrow more money, right? And interest rates tend to really have an impact there. And so there's not really kind of a one size fits all across the market. You really have to unpack what is the asset asset class I'm looking at? What is the individual security or individual investment opportunity? And then what is the factor here? Is it liquidity? Is it interest rates? Is it both? How do I weigh on that? And so, there are certain areas of the market that I would actually argue interest rates, like real estate for sure, is more important than global liquidity. But on a overall metric, I think that global liquidity is probably the bigger deal for most people's portfolio, because usually most people's portfolio is majority equities rather than some of the more interest rate sensitive asset classes. And so Sam Callahan and Lynn Alden did this great study where they showed that Bitcoin is the single most sensitive asset to global liquidity changes. So if global liquidity increases, Bitcoin has kind of the most pronounced positive kind of response. If global liquidity starts to go down, then Bitcoin has the most pronounced negative reaction as well, right? It's hypersensitive to global liquidity. And so over a long period of time, that's great because structurally liquidity is going to increase. But what we've seen in the last couple of weeks here is that global liquidity has actually been going down. And so naturally the S&P turned over, Bitcoin turned over, right? We got these drawdowns. And so the question becomes, how much is it going to draw down? I tend to think that about here feels like some good timing. Now, why is that? Because I think that Donald Trump coming into the White House, he's already tweeting saying that interest rates are too high, right? He's already talking about a bunch of things that tend to increase liquidity into the market. And so you have to really, to be a good investor in my experience, you've got to not only be able to understand the financial metrics, but then you got to be able to overlay domestic politics, geopolitics, and then you've got to look at specific policies that may have an impact as well. And so that's what makes, I think, investing so intellectually stimulating, but it's also what makes it so difficult is that there is intense complexity to these machines that are markets. And so you got to understand, well, if this thing gets pulled or if this button gets pushed, what's the impact? How does it work itself through the system? I'm not claiming to be an expert, right? But definitely as a student of this stuff, you begin to understand how some of this stuff relates to each other, and it makes you a much better investor if you can do that.
Anthony Pompliano explains the critical role global liquidity plays in shaping asset prices, including Bitcoin. He compares liquidity to interest rates, noting how rate cuts make capital cheaper, increasing market friction when raised or reducing it when lowered. Anthony emphasizes Bitcoin's unique position as the most sensitive asset to global liquidity. When liquidity increases, Bitcoin sees the most dramatic positive response, and vice versa. While short-term liquidity dips may cause downturns, long-term trends favor Bitcoin as liquidity continues to grow over time. Don't miss what's next. It's game-changing.
If you think about AI and Bitcoin, I've been writing for a long time that this is all about automation. Everyone wants to say Bitcoin's in one corner and artificial intelligence in another corner. I think that these are all part of the same trend, which is automation. And what do I mean by that? If you think about what artificial intelligence is kind of promises to be, we are going to write software, and that software is going to automate away human time, effort, etc. AI is automating away that time and effort from the human. Now, if we go and we look at what Bitcoin did, Bitcoin used software to automate away the time and effort that usually humans would put towards monetary policy. And it just said, we're just going to write this in software. And so again, Bitcoin automated that central banking function for this new type of digital currency. And so now all of a sudden you say, well, hold on a second, it's just software that's automating human time and effort. So now you can start to see the commonalities. I think that there's a very good chance inflation may come back, right? You have a delicate situation where they never got inflation under control. Trump is walking into 2.8% inflation. That's high inflation compared to the target. It's almost 50% higher than they wanted. And so now what you're going to do is you have interest rates coming down. You have, up until recently, stocks and asset prices higher. And you have new policies that are coming in that have the potential to be inflationary. Thankfully, you also have a very important activity in Doge, which is trying to cut expenses. You may have a weird impact on inflation in the deportation of a lot of labor and the stopping of more labor coming into the market. And so you put all that together and it's a murky, muddy water. It's not clear what's going to happen. The thing that I would say that I think is really important for people is when you look at inflation, you have to realize that inflation is higher than they're telling you. So let's just say, we'll use easy numbers. Inflation's at 3%. I think it's probably higher, but let's just say it's at 3%. Right now, on various treasuries, 4.5% to 5%. So if I hold that, I pay taxes on the interest, and let's just use easy numbers. And let's say that I pay 40% tax. So I get paid 5% interest, pay 40% in tax, and then I've got a 3% inflation rate. Whoops. I had no real return. If interest rates are at 5%, if interest rates are at 4.5%, now I actually have a negative real rate of return because of taxes and inflation. And so what it starts to do is it actually starts to make more sense as to what is happening with equities. The value of equities, the return on an annual basis has been creeping up. It was, 7%, then we got into 8, 9%, right? Now we've put up 2 years of over 20%. Well, the businesses are getting better. Another thing that people don't realize is not only are the businesses in terms of net cash flow improving, it's about a 5x since 1970. Also, the revenue per employee has been drastically increasing over the last couple of years. So the companies are getting more efficient, they're more dominant, which again drives those asset prices. And so if you go back to this idea of inflation, asset prices going up can be inflationary if it enriches people. Then now they have more money and they go and they spend it in the market. But instead, what is the bigger concern is not that. That we could live with. The bigger concern is the government going to do something? Are some of these new policies going to be inflationary? Are tariffs going to create issues, right? I actually think that people are overreacting to a lot of the tariff talk. I think that people are misunderstanding the strategy that is at play right now. I think a lot of people think Donald Trump on January 20th is going to walk in there and be like, tariff, 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 tariff. Instead, what I think he's doing already is threat of tariff, threat of tariff, threat of tariff. And that is bringing a lot of people to the negotiating table. And so we'll see what gets implemented. But all these little things could be inflationary. But the biggest issue is that we never got inflation under control. We never got it back down to 2%. And so already we're on an elevated base. If you get any sort of resurgence, we'll be back to 4.5% pretty quickly if we're not careful.
Anthony Pompliano's insights reveal a future where global liquidity isn't just a market force. It's the key to understanding Bitcoin's price movements. From interest rate shifts to political strategies, the financial world is a complex puzzle, and Bitcoin sits at its center. If you're serious about staying ahead in the crypto space, these lessons are essential. Make sure to subscribe for more interviews uncovering the strategies that shape the world of Bitcoin and beyond. Until next time.